this particular industry, and they expect, number one, it's too early to give a credible value to new ventures, especially with large conglomerates entering the space. So overall, they're positive on the space, but they're quite cautious, especially when it comes to share price returns from this point on the back of deteriorating returns that they expect, given the fact that it's cyclically peak.
All right. Nice wordplay and the title of the report, Sand, Gold, price of gold, value of sand. We'll talk about, we'll discuss this in greater detail with the analysts concerned. But Vivek, thank you very much. Market open right on cue. 23,210 is where the Nifty is at, about 1/3% higher. The Nifty Bank is up about 0.5%, 51,065. The small cap index is that down 3/4? It's showing 3/4% lower. Okay, no, I think that's changed. 0.14 higher on the small cap index, more like it. The mid cap index will come up on your screen next, and that'll give you an indication as well. About 0.16, 0.15 higher on the mid cap index as well. So it's a pretty decent start. But last 2-3 days, go back to last, I think Thursday, Friday, and this week, of course, as well. The open has been pretty useless in trying to predict how the close actually has been. Because you tend to see a fair bit of shifts coming through. So we need to watch this one. It's almost equal number of gainers and losers cut in the middle, and the heat map, Nifty heat map, is giving you that sense. 40 points though for now on the Nifty, 23,200. Let's do stocks now, Surbhi.
Okay, Tata Consumer. We should maybe get Nivesh back, when he was just telling us about that report. The Goldman Sachs upgrade. The stock is flying 6.5%. I went back and just checked the numbers. Goldman Sachs is saying that FY26 EPS will be higher by 3%. Next year, they've increased it by 7%. Look at the stock, 6% higher. As we're seeing, the target is, by the way, 1,200 on Tata Consumer. And that's the best performer on the Nifty. Let's move on and see what else is working. Infosys, Tech Mahindra. There's some buying in large cap, auto, some of the other larger stocks like ICICI Bank, HDFC Bank also holding up. There is a little bit of positive move on Trent again this morning, 0.7% higher. There's ONGC, Apollo Hospitals, Titan. It's a whole mix. ITC, lots of stocks moving on the upside. The downside, Nestle's fall is a little pronounced, about 3% down on Nestle. Even Lever is down, actually. Lever's down about 1.5%. These two names from the FMCG basket. BEL is continuing to cool off as it did yesterday as well. And there's some weakness in Power Grid as well. So a couple of these PSU names are cooling off. But the stock of the morning definitely has to be Tata Consumer, still up almost 5%.
Well, that's right. Tata Consumer, that one's bursting away in trade. On the flip side, Nestle is down closer on 3%. So that's coming for some profit taking. BEL as well, down closer around 2.5%. So that's under some pressure. And HUL is another one that's on the losing end, which is down closer around 2%. What's doing well actually today is the tech index. Let's pull up the tech index. The Nasdaq did relatively better overnight, and the street seems to be taking a cue from there. Infosys is up, Tech Mahindra is up as well. Both of them doing pretty well. HDFC Bank, yesterday the stock went, ended the day at the low point of the day. That's the fear with regard to the quarterly update. For starters, at least it's up closer around 1% or thereabouts. From the broader markets, what's under pressure? You have Central Bank of India that's down 10%. So big downtick is what we're seeing out there. ITC Hotels, the stock is down 2%. Yesterday, towards the end of trade, it went higher on very, very large volumes. So I'll be interested to see what happens on, ITC Hotels from this point on. It's down closer around 2% or thereabouts. But otherwise, a good start to trade. A bit of a flip-flop from what we saw yesterday. Yesterday, you had the index that was under pressure, but you had the broader markets that outperformed. Today, it's a bit of a role reversal. Mid-cap index is down closer around 0.2%. While the headline index is higher.
Absolutely. And 50 points now, I think 23,212 is where the Nifty is trading at. Maybe just a few more names. Actually, by the way, 1,400 stocks are lower and about 800 stocks are higher at this point. I mean, all these Vari and the Solar Premier and, these are all down between 2 to 4% or so. Dabur is down about 2%. That's coming up with some volumes. I think we will be speaking with the management of KEC in a bit. Sorry, I think 2% lower, 775 on KEC. It's got some volumes as well at this point. Nestle is down about 3%. Stocks at 2162. And of course, I think we already mentioned Central Bank and BEL earlier. So those are other names. Quest Corp maybe on the upside. 6% on Quest Corp is the number two volume-led gainer on the across the board. 701 or so on Quest Corp. There is AG's Logistics, which is up about 4%. Lodha, there is Macrotech, is coming up with about a 2% pop. It's got decent sized volumes for this point in the day. And Credit Access is another one, which is up about 1.5, 1.7. But I mean, still 9.8, 9.70, 9.80 in that zone. V-Mart is up 3%. Stocks at about 3,045 at this point, but it's got no real volumes at all right now.
I'm just checking Central Bank of India. Let's pull up the stock. Yeah, I mean, I was just checking, my screen is wrong, but 9-10% down on Central Bank of India. A little unusual, yeah. I checked it from the exchange as well. Indeed, that's a sharp knock. We'll just look into it and see if there's anything very specific. Otherwise, I mean, some of the other banks where updates have come out, like CSB Bank, they've been doing pretty okay. CSB, I think, is still holding up. But yeah, I just wanted to point that out. It's a bit of an unusual move on Central Bank of India.
All right, well, let's welcome in Trideep Bhattacharya, President and Chief Investment Officer Equities at Edelweiss Mutual Fund. He's with us here in our studios. Trideep, good to see you.
Good to see you in person. Thanks for having me here.
So, how are you feeling about the market and in stock picking? And I mean, what have you been doing? Give us a sense through the course of this year.
I think if I were to summarize the market today, it will be receding macro uncertainty. Earnings still uncertain, but at this point in time, I would say that expectations are reasonably benign. So a combination of all of these three is what we are seeing market, where I think
which is the first one? Receding macro uncertainty.
Yeah. So I think with the Trump, whatever he says this today or in a week's time, we are almost ending a year and a half of macro uncertainty, starting with Indian elections, its impact on earnings, and now Trump and his impact on earnings. And after this, as we move on, the earnings start to take precedence. It will take some time to adjust, which is why I called out uncertain earnings, particularly in this result season. But if you give it 1 or 2 quarters, I think earnings will also start to come back. Net in FY25, putting all of these together in numbers, we started off with expecting roughly about 15% growth in earnings. We are going to end up being practically flat. So almost about 12-13% cut in earnings. And as we head into FY26, by the time we end it, I think we should touch double digits. So it's basically an earnings reset, summarizing macro uncertainty and gradually making a comeback. So that will be my summary of how I read the situation right now.
All right. Hi, Trideep. Good to have you in the studio. But you think the street is prepared to look through a weak showing in Q4 earnings? Because it's not going to be great. However, the commentary could be very, very good. And the low base effect will play out from there on, Q1, Q2 as well. So looking through Q4, that's par for the course. That's okay?
I think it gets very company specific from here. Like you read out some of the stock specific movements. If it is within a range, would be probably taken okay.
Yeah.
But if it kind of beats or misses beyond a particular 5% range, would be kind of I think you would see severe reaction onto that. I still think that market this result season will miss the gunpowder of earnings.
Okay.
Earnings upgrades, which you've sort of lost our mojo from roughly about September quarter onwards. I see that coming back maybe June or September quarter this year. Till that point in time, we might get into a bit of a time correction, get of a flattish market where we have to kind of live on stock picking to kind of outperform the markets. And from there on, we start to take off, would be my read.
All right. So you're saying the street is prepared, that Q4, no great shakes.
Yeah.
Since there's so much of uncertainty with regard to Trump's tariffs, or call it tamasha, whichever way you like to term it, let's talk about domestic-facing themes.
Yeah.
The real estate space is something that you've liked in the past.
Yeah.
Both the core real estate players as well as the ancillaries.
Yeah.
Do you think that theme is good for more?
I think, first of all, it has done quite well over the last couple of years. And I think we are in the twilight zone where the second part of real estate, which is the ancillary sectors, like, for instance, building materials, which haven't done well at all, they might actually see a bit of a time in the day over the next couple of years.
Right.
So I think real estate builders is what you probably talk about as the primary beneficiaries of real estate theme, have played out more or less. There's some more remaining to come. But I think where valuations are reasonable are in the building material space, which should pick up over the next couple of years, is where I have my eyes on.
Okay, that's quite interesting. Let me actually build on that, Trideep. So a combination of reasonable value and reasonable growth. One pocket you've identified, building material, allied real estate plays. What else?
I would say that there are pockets within quite a lot of sectors where there is value. So, for example, within financials, there is NBFCs, reasonable valuations, decent growth, and particularly if the regulation eases out a bit, they would stand to benefit from the same. I would say probably chemicals. They are making a comeback after 4 or 5 years of hiatus.
But isn't that still very risky because it's a fully globally, facing globally linked sector?
It is.
Supply chains, etc., with so much going on. Would you still bat for chemicals?
Tactically, but because there is a price shortage, which is kind of which is leading to buoyant prices, which will benefit the sector.
And which kinds? I mean, it's a very large basket without getting into names, but generally, I mean, are you looking at pharma intermediaries or would you be looking at the whole fluorine chemistry part of it? Any particular?
Chemistry mostly.
Fluorine chemistry, got it.
And whatnot. And thirdly, power. I think within subsegments of power, where companies can have a bit of a moat and make margins, I think that's the place to be. So those would be 3 subsectors, not big sectors, where I think money could be made in the next year or so.
So pharma, NBFCs and select chemicals.
Yeah.
Got it.
Any names in pharma? I mean, just for educational purposes.
We'll keep the education out. We'll limit to sectors. But I think one of the other things which I do see in the market happening is basically shifting profit pools. I think what's happening is there is competition coming in almost every sector from different directions, which will take supernormal profits out. So I think the other way to slice and dice your question is over the next 1 or 2 years, the execution kings within the sector would actually stand to do significantly better than others. Because as outsiders try to want a share of the profit pool, and I mean, of late, we saw in wire and cables, the pharma sector with the GLP-1 and many different kind of, such incidents. I haven't seen in my last 25 years in one go so many sectors impacted by disruptive forces at a time. So interesting time ahead.
What about the telecom space? Suddenly we're going to be getting used to a 3-player market. I mean, the third one's going to survive. The government of India is now the largest stakeholder in there. What do you make of that? I mean, will you look at the one that could survive, the core telecom player, or the other large conglomerate?
Quite frankly, having done a bit of global investing, telecom has not been a great place for investors. A bit like airlines, as Buffett would say. So within this, I think there is one large incumbent which will stand to benefit from that. Maybe slightly higher competition in the near term, but on net balance, what's happening is really kicking the can down the road. I don't think it's a solution to the problem of the troubled entity that you're talking about. On net balance, I think the incumbent player should stand to benefit from the same.
The core player.
Yeah, core player.
Okay, all right. Since you spoke about aviation, there's one core play over here. And Interglobe Aviation has seen a big run. You have crude oil prices that are benign, which is good for them. Yeah. And I was just doing a rough check the next few months as well. Airline fares are going through the roof.
Yeah.
Do you think that's going to hold them in good stead? It's already had a big run. It had a dip when you had a couple of entities selling. But those dips are getting bought into. There's plenty of appetite.
Yeah.
Your view?
So my sense is that luxury, and this is, of course, there is a value end to it, but luxury, travel, leisure, hotels, these are the place to be in the next couple of years overall.
Good for more even from here?
Good for more even from here. Because I think if you look at even the hotel sector, for instance, people expected the prices to peak out a couple of years ago, but actually, if you see today, even them they are kind of rising as we speak and have further room to go.
Yes.
So I think net hotels, hospitals, less so aviation, I must admit, are places where I think a few other pockets where structurally money could be made over the next 2 or 3 years.
And you're not too uncomfortable with the valuations there? I mean, especially after this correction now?
Yeah, so valuations have become reasonable. They will not be die-hard cheap because obviously there is economic momentum in there. You've got to pick your spots, but within that, yes, I am comfortable with a few names. We hold it in our portfolios.
I completely agree with hospitals. Hotels, I don't know. Hospitals, I agree with. I mean, hotels also, they've done well. Why not, right? But hospitals...
See, one, you have to go to one place by force. The other, you go by choice. But eventually, you have to sort of deal with both.
A friend of mine was saying that instead of buying insurance policies, obviously, it's not serious. I was just joking. Might as well buy stocks, right? I mean, you'll healthcare costs rise, 10, 15, 20% every year?
Yeah, oh, it's huge.
And you got
premiums have been shooting higher.
Maybe some appreciation in stocks as well, which takes care of the cost. But of course, as I said, buy your healthcare insurance policies, absolutely. But what else, Trideep? You're not sounding. It's sounding. You said interesting times ahead. Sounded to me like tough times ahead, Trideep.
I think for it's old school bottom up stock picking time ahead. Basically, that's what I mean. The easy answers, the big themes, the manufacturing themes
All that
like
is
it played out,
done, dusted.
those are kind of, our themes of yesterday. Going forward, and as I said, the profit pool are shifting within the sector. So which spot you pick within the sector is important. And then a couple of shades, where a little bit of momentum is there from a sectoral theme standpoint. So it's basically die-hard stock picking, and hence I'm sounding a little kind of, the easy pickings are done. It's hard work ahead.
The rising tide is now flattened.
Correct.
There's no.
He's actually sounding a little optimistic to me because he's brimming with ideas. And like you're saying, this is, I think, is going to be the period that will separate the men from the boys in terms of fund managers. So very interesting times ahead. Having said that, just a quick final question from my end. So the general wisdom in the market, if you ask, 8 out of 10 people will still tell you that don't go to mid caps, large caps is the way to go, etc., etc. But let's face it, we need some mid caps in our portfolios as well. Now there, what is the approach? Where do you see still too much of over exuberance? Where, which are the interesting mid cap opportunities?
So I think first, I must admit that when I look at a business for stock picking perspective, it's very unlikely that I look at large, mid or small. We look at the quality of the business, the moat that it has, and the growth prospects and whatnot. And in that context, in some of the subsectors that I mentioned, the largest companies are actually mid caps.
Mid caps, yeah.
So, and you could call them mid caps and hence higher exposure to mid caps. But overall, I think, as I said, there are certain segments within mid cap domain which are hardly there in a large cap. For example, if you look at hotels, hospitals, and
even chemical companies, it's all mid caps.
Chemicals or capital markets. These are not part of large caps at all. So for you to hunt in these spaces, you've got to kind of dig deep down as well. And I think that's where I was meaning that one has to deep dive to get to those pockets where there is value, and hopefully kind of, we can tide this period through. So
without
that's
the
my
tide.
recipe.
Tide this period through without the tide.
Without getting swept away.
No, but yeah, it's. I think Sanjeev Prasad was with us yesterday, and he was also making the similar. The competition is we don't talk about it too much, right? We talk about companies and what they can do, but so many sectors seeing disruption, extra competition, etc. So. I have to take note of all of that. Thank you very much, Sudeep. Appreciate your time here.
Pleasure.
And thank you for dropping by
to
the studios. I think, the market, by the way, the Nifty, it flatlined and then now we have a 100-point gain. So it's a bit of a, already we've had quite a bit of a move on the Nifty index from the opening level to the low that we saw. I think we were up just 10 points at the low, and now being up about 100-odd points on the index. Market breadth is still slightly negative. 900 stocks are higher and about 1,500 stocks are lower to sort of begin the session. Nigel.
All right, well, let's talk about KEC International. They backed new orders worth around 1,200 crore rupees for the T&D projects in India and West Asia. To discuss these order wins, their business outlook as well, we're joined by Mr. Vimal Kejriwal, the Managing Director and CEO at KEC. Hi, Mr. Kejriwal. Good morning. Thanks a lot for joining in. Well, give us a few details. What was the total order inflows that we saw in Q4? And if you could tell us, for the year, it appears you have surpassed the guidance that you've given on order inflows. What was the number you're ending at?
So Nigel, I think Q4, if I'm not mistaken, we're around 6,000 crores of order intake. We are still L1 in some of them. People are saying we'll issue it on 31st. Let's hope that we do it. But anyway, we are very close to 25,000 crores. We are not surpassed the guidance in that sense because we are slightly below 25. Okay, we had said we'll do 25,000. And if you look at these orders, 55-60% is from transmission, and then civil, and then cables. I think that's the broad breakup of this particular order.
Okay, all right. And what about for the coming year? Since you're saying you're L1 in some positions, could you tell us, could you quantify the book at which you're L1? And for FY26, what kind of an order inflow are you looking at? What does this take your current order book first to?
So our order book plus L1 currently is around 38,000 crores. Okay. And it will go down slightly because we'll still have to factor in what would be the March revenues, etc. So I think broadly we'll end up around 37,000, including L1 for the year. That's our expectation. We expect to grow around 15% or so next year. So we are still working out our order intake target, but it will definitely be 30,000 crore plus.
34,000 crores plus. Okay. All right. I got that, Mr. Kejriwal. Great to have you on. Just going back, I mean, looking at the overall environment and how you're looking at the bidding pipeline ahead for this year, FY26. I mean, we've discussed this in the past that, you know, the margin profile didn't improve as much as you would have liked it to in Q3, but you've always been maintaining that FY26 and 27 will be much better from a margin expansion perspective. I mean, you've been talking about levels of maybe even 9%. So looking at the bidding intensity, the pipeline, are you still confident of getting to those levels?
So to me, what is happening is that bidding pipeline is definitely increasing. We've always been talking about around 1,40,000, 1,50,000 tender pipeline. Right now, it's gone above that. It's almost 1,70,000, 1,75,000. A large part is driven by Middle East also, and also especially Saudi. Also, we are seeing water projects which were on hold getting sort of bid out. So some traction we are seeing on the water side also, which is why the bidding pipeline seems to have increased by 25,000 crores as compared to last time. Margins, I think we are pretty comfortable. We have given a guidance next year of 8 to 9%, and I think we are pretty hopeful of doing that because a large number of legacy projects are getting over or have got over in FY25. So I think 26 and 27 should definitely be better on the margin side.
Okay. Which of the segments, I mean, where you're likely to see maximum traction? Of course, I mean, the last couple of orders, you've managed several orders from the Middle East as well. In India, I mean, in all our past conversations, you've been telling us that obviously the T&D segment has been doing well. Railways was weak. So now, as you sort of look forward to this year, let's say talk about the next 4 to 5 months at least, which segments will drive the order book growth?
So primarily it will still be T&D. Even this year, out of our order intake of roughly 25,000, 72% is T&D. And if you look at that number itself, T&D, almost 60% is international and 40 is India. So although, you know, we understand India T&D much more and we track it much more, I'm just generally saying that T&D International also is doing very, very well. So T&D will clearly drive. Second piece will be civil, which was a bit, I'll say, low this year on order intake. We do expect that to I'll say go up significantly, especially driven by residential and the water piece. And we're still seeing a lot of traction happening on the metals, mining, etc. So most of our orders in industrial have been on the steel side. Okay, so I think these are the three areas which we see driving our order book next year. Sorry, FY26.
Okay, so T&D remains the primary workhorse.
Yes.
Metals and
Yes.
mining. And also civil construction opportunities with real estate seeing hectic activity. Got that.
Yes.
Final question, sir. Again, and this is coming from the past where you spoke about labor issues that were sort of becoming a bit of a challenge to deal with. Has that sorted out?
So let me put it this way. It is sorted out, but we are trying unconventional means, etc., which were not been like, we were never using labor aggregators, contractors like that. So we have started using them. Obviously, the mechanization has picked up a lot. So we are trying to see how do we sort of optimize the need for labor. It's improving. I'll say it's slightly better than the last quarter.
Okay. Good to know. Thank you very much, sir, for joining in. We'll, of course, connect again once the Q4 numbers are out, and we'll have more questions for you. But thank you very much for joining in this morning. That is KEC International with, sort of an update on their order book. They're saying 25,000 crores was the target, maybe just slightly shy of that. That's how they will be closing out FY25. Let's move on and get you our special segment, Young Turks Reloaded. Shireen sat down with PVR Inox's MD Ajay Bijli to look back at the incredible journey from a single-screen theatre to India's largest multiplex chain. Ajay speaks about how he plans to adopt an asset-light model for new cinema expansion to improve margins. Take a look.
On the consuming habits changing, and what this potentially now means as far as occupancy is concerned, you know, it's been stagnant at around this 25%, 25.7% for the last quarter is the occupancy levels. What do you do now to drive footfalls? Because the experience is in your control. The content is not. You can't do anything about the content.
I'm still as sanguine and optimistic about the business. So when I go and look deep into what happened 2021, 22, 23, 24, 24, 25, which is going on just now, the number of movies, first of all, got reduced. Only 85 Hollywood films got released. as opposed to 174 movies. This year, again, the number is going above 150 because that screenwriters strike and
Right.
all that
Yeah.
happened. So if the movies become 175 or 174, that means you've got more content.
Yeah.
The chances of hits and misses will always remain.
Sure.
But because...
Hopefully more
Yeah.
hits.
So our businesses in India, this is the only market I'm comfortable with, is a volume-driven business. Volume in consumption and volume in supply. So therefore, if one or two movies don't do well, doesn't bother me because you'll always have a sleeper hit that makes up for a movie with high expectation that gets compensated. So I think because the movie flow coming in, it'll be more appealing even to the consumer. Even in India, a lot of movies got bunched up in 23 and 24 because shootings had stopped. So Shah Rukh Khan, 3 movies got released in 1 year, which is unheard of.
Yeah.
Amir Khan, no movie has still got released post-pandemic. Ranbir won, Hrithik only won. All these guys also, to be honest with you, and obviously that's my supply side, were also a little figuring out what does the consumer want. I think now they've got their act together. A lot of work got done on the script. And as I say, it has to be on the page before it goes on the stage.
Yeah.
Sorry, I'm quoting these.
No, please quote away. More dialogues. We are in a movie theatre.
So I think a lot of time is getting put on what's on the page. And I feel that this 25, 26 onwards, these occupancy levels that we're talking about are bound to improve. Because the supply side
But hope
is looking...
can't be a strategy, right?
Hope is not a strategy.
Yeah.
So what we are doing is a couple of things. I'm saying, okay, if we reach the 31% level, excellent. If we don't, let's align all our costs and our strategies to 25, 26%.
Right.
Okay.
Right.
So therefore, one is that FOCO model.
Yes.
I've already spent 5,200 crores on this circuit by inorganic and organic.
Yeah.
So we are only doing what hotels have done all their lives.
Yes.
Okay. Basically monetize the brand.
Yeah.
And have...
So somebody else sets up the infrastructure, you run it for them.
Correct.
To put it simply.
Absolutely.
Yeah.
And I must confess that I've been fortunate enough to meet a lot of chief executives of Trent, various other Titan, hotel like Puneet Chatwal. I've exchanged a lot of notes. Nobody in the exhibition business has done this globally. First time in India, this has been done.
And first time worldwide?
Worldwide,
Okay.
yeah. So we're very fortunate, and some of the developers, have been incredible. People like DLF, I don't mind mentioning them, I'm a big fan. They've also realized that this is the model to go. Cinema is a necessity for their shopping centers. They will invest some money and we will manage it. And in smaller towns, tier 3, tier 2 also, we've had this response. Like people feel very proud to be part of a hotel.
Right.
People own a hotel or a Tanishq.
Yeah.
Or a Titan or a Zudio or whatever. Similarly, they have this pride that, PVR is mine or an Inox is mine, and they spend the money. We've had to spend more money on our SOPs, brand, and what we bring to the table. So that's one thing that we've done to make sure our ROCE improves.
Yeah.
If we can do more and more screens, around 100 screens got signed last year. This year also about 100 odd screens.
So who are these developers who are coming on board for the 100 screens that you've already got in play and the additional that you are looking at?
Mix of people who are organized and unorganized. One are just one off, two off, in Jaipur, Udaipurs of the world, Nandeds, Ujjains, Indore, Kota, these kind of Ajmer, these kind of places, and then big ones who definitely need a cinema, and then they are also. So a mixed bag, but we've got a tremendous response.
So what does it mean in terms of additional revenue? Because, on the back of the management fee that you're going to be able to get in from this.
So initial fee, technical fee, and then management fee, that is one. That's one model that we're doing. And then line by line costs, we're looking at, and also all the new deals that we're doing are all on revenue share. That will make sure that the volatility taken care of. So the minimum guarantee are paid, but their minimum guarantee is not very high rentals. And also when the business is good, then they share the spoils with us because we give them a revenue share. So that's one model. Other is line by line, zero-based, costing of every single, whether it's manpower, marketing, electricity. We're looking at a lot of solar to help us bring the cost down. So we're saying that if we, even at 25%, if we can get those margins that we were getting pre-COVID, we are okay. But if we do go back to the occupancies we were getting pre-COVID, then fantastic. That's all gravy. Other than that, the 3 Fs that I spoke
Yes.
about, I'm saying that we already have an infrastructure. We
Yeah.
have 15 million square feet, in India, which is, by the way, I think the largest for any retailer.
Yeah.
I think so, I've been
Yeah.
told. Why can't we use those spaces
Yeah.
for alternative, kind of entertainment? So that's the fun part.
Yes.
Some by repurposing the cinemas, some without repurposing. So if we're showing IPL, we don't need to repurpose. If we show Taylor Swift's Eras tour, we didn't have to repurpose. BTS, we didn't need to repurpose. A comedy, stand-up comedy, whatever, all those
Yeah,
kind of
yeah.
things. We did something called Candlelight show. Those are without any repurposing.
Right.
There's one more strategy that we're doing. We're doing about 4 pilots just now. One in Bangalore, Gurgaon, Bombay, everywhere, where we're repurposing certain cinemas, creating green rooms, having bleachers where your seats can, combining 200-300-seater cinemas into one
Okay.
seat, this thing, and doing gaming.
Okay.
Going, and by the way, everybody's not Ed Sheeran and Coldplay or Diljit Dosanjh.
Yes.
You have so many artists who are happy with 1,000-seating capacity getting filled
Yeah.
up. So I'm, as you know, fond of music as well.
Yes, we know.
So I'm in touch with a lot of artists, a lot of managers. There's so
So
many artists.
you're getting into the kind of Book My Show, Zomato district kind of space?
Only providing the infrastructure.
Right.
So I don't want to do something that I can't. There are experts who are doing it, whether it's district or whether it is.
So do you tie up with them?
We tie. They can, sell our tickets. And so that's the fun part. Where can we repurpose our cinemas? Some amazing things are happening on some of the projects which are basically still under fit out.
All right, so that is PVR 2.0, how they're reimagining the business given the new environment. Young Turks Reloaded. You can catch the show, which is going to be coming soon on CNBC-TV18. All right, time now for a quick break. Up next, Anup Vadhavan, former Commerce Secretary, as well as Abhijit Das, international trade expert, will be joining in to talk about what Trump's new tariffs could mean for India.
Okay, welcome back. We're, of course, talking about Trump tariffs. Tonight is the moment of truth when we will know what President Trump wants to do as far as tariffs are concerned. And tomorrow morning, of course, we'll be reacting to it. I just thought, before we dive into our next discussion, put 2 data points on board. One is, what is the impact on India? I mean, of course, it depends on the tariffs which are imposed. Now, JP Morgan economists say that the difference between the tariffs which India imposes on the US and US imposes on India on a weighted average basis is about 8%. So, I mean, if the increase were to be just that, 8%, the impact would be about 20 basis point hit on GDP. If JP Morgan economists say the Trump administration decides to include VAT of 18%, you're essentially looking at an impact of 50 basis points as far as GDP is concerned. So, I mean, this is data points as we are looking at it. And of course, this does not include what India is already offering. As Parikshit has been telling us and our Delhi reporting team has been telling us, there have been hectic parlays and proposals, and maybe more firmer kind of proposal is being readied. Maybe it's been discussed with Trump administration, and Trump, of course, is on record, and they've said that some of this stuff is indeed happening, and they will be sort of taking note of it. So we don't know the reaction function, and of course what Trump is going to make of it, and then sort of will that mean a carve out in some sense for India, etc. So without knowing all of that, I mean, this essentially are the numbers. This is this particular table is sector-wise exports to the US, ranked by the contribution to the GDP. India's exports to US percentage GDP. This is tariffs imposed by US and India, and this is tariffs imposed by India on the US. So the way to do this is basically you take this number, subtract that number. That is essentially the difference, which if they're going to be purely reciprocal, and if they go sector-wise, I mean, you get a sense of where the hit is likely to come. And here, and taking into account contribution to GDP, there are three sectors which are in focus. One is pharma, the other one is textiles and clothing, and the last one is agri and meat products. I mean, here the difference is the largest, and the contribution is not very small. I mean, it's still small, but as relative to some of the other sectors, these are the three areas, these are the three sectors where perhaps the impact looks higher, perhaps they are more vulnerable as well. So let's, with this short kind of sort of setup or a preamble, let me welcome in Anup Vadhavan, former Commerce Secretary, and Abhijit Das, International Trade Expert and former Head Center for WTO Studies. Thank you very much, gentlemen. Appreciate your time here on CNBC-TV18. Mr. Vadhavan, if I can start with you, sir. You must have seen news reports about proposals being readied here in India to lower tariffs. What can we here in India in terms, offer? I think the deficit is about to the tune of about a little over $40 billion as of the last financial year. What can India offer to offset, to preempt some of these tariffs, which are going to be announced later today? Go on.
I think, that is not very consistent with our intention to have a bilateral trade agreement negotiation in good faith. So there is a view that, that might be kept in mind by the US. We had a very successful visit by Mr. Brendan Leach recently. And so there is some conjecture, perhaps with significant basis, that the US might realize that, these reciprocal tariffs and the acrimony associated with them and the tensions associated with them are not consistent with the good faith, bilateral trade negotiations. So it is still conjecture as to what will happen, and as to what India can give will all be part of the negotiation. And typically trade agreements are balanced. You give mutual concessions which are commensurate with each other and balance the trade agreement. So certainly, areas of US interest, they have some interests in things like, motorcycles and...
Vadhavan, if I can come in, you're saying the lowering tariffs now will not be consistent with trying to strike a bilateral trade deal. Is that what you're saying?
Absolutely. Absolutely. All that has to be negotiated as a matter of give and take in the trade deal. Trade deals involve give and take. You take American...
But the point is, so you're saying take the reciprocal tariffs as they come, that's more consistent, and then negotiate a deal separately. That's the way to do it.
What I'm saying is that reciprocal tariffs should not come. If better sense prevails as it should, reciprocal tariffs should not come. Quick trade negotiation should happen, and you should reach an early harvest agreement on goods of interest, which both countries have in their wish list. So that is what I'm saying.
So it's possible, Mr. Vadhavan, you're saying that if better sense prevails, I mean, now who knows, but it's possible later today when we hear about countries where this will be imposed, you're saying it's possible the Trump administration says since discussions with India are in advanced stages and they're happy about what they're seeing, we're going to hold off in terms of tariffs on India. It's possible.
It is entirely possible in my view. Let's see what happens. If reciprocal duties are imposed, we have to see what the levels are, what the goods are on which they are imposed, and then we'll have to, take stock of that and suitably react to it. So that becomes a separate, channel away from that trade negotiation. That has to be dealt with separately, and let's see what happens.
All right, fair enough. I mean, I think that gives a fair sense. Now, let's welcome in Abhijit Das as well. Mr. Das, good to have you on the program. What is your sense? You heard Mr. Vadhavan.
Dr. Vadhavan has given one side of the picture. No doubt that there is a possibility that India might be spared of the reciprocal tariffs. But to my mind, that possibility is rather low. If we look at President Trump's statements over the past 3-4 days, it doesn't give me much ground for optimism that India will be spared of the reciprocal tariffs. If India does have to confront reciprocal tariffs, then this clearly, to my mind, would be something like a breach of good faith, since India and US are already engaged in the bilateral trade agreement negotiations. It would be prudent for US not to impose the reciprocal tariffs. But as all of us know at this juncture, prudence doesn't seem to be the order of the day. So to my mind, the possibility is fairly high that India will be at the receiving end of reciprocal tariffs. What will be the extent? What will be the sectors? I'm sure we'll have to just wait for a few hours and then we'll get to know where we stand on reciprocal tariffs. But as Dr. Vadhavan said, if we are confronted with reciprocal tariffs, then while the BTA negotiations continue, we must not hesitate in trying to protect our national interests. And one way to do it would be to impose some tariffs from our side as a signal mainly. Otherwise, if we don't do it, then in the bilateral trade agreement negotiations, much of our negotiating capital will be spent in getting rid of the reciprocal tariffs, whereas in the BTA negotiations, our endeavor should instead be to see if we can secure new and additional market access in the US in sectors like textiles and clothing and leather.
Gentlemen, I also want to draw your attention to the remark that Mr. Trump made overnight. He said that, and I quote, "I heard that India is going to be dropping its tariffs substantially." So I don't know. I mean, the fine point or the finer points will only be revealed once those trade negotiations are done. Because tonight we'll only get the US number. And what is India willing to relent on, that we have to see. But some signs are already there. For instance, bourbon whiskey, cars, all that is already up in the air. So Mr. Das, if you could come in on this, which could be some of the product lines, tariff lines, where if we cut a little bit, it will not hurt our trade interests too much? Which could be those segments?
In the industrial goods sector, there is not too much that US can export to us. So one could be fairly selective, fairly targeted, and India could cut tariffs. But as Dr. Vadhavan said earlier, the tariff cuts should not be unilateral. These should be accompanied with the United States extending tariff concessions on products of our interest. Otherwise, what will happen is, if we keep on giving unilateral concessions, which we seem to have done so far, we will not get anything in return. US will only pocket those concessions. Bear in mind that these are negotiations, and in negotiations, it's a matter of give and take.
Yeah.
So we have to make sure that concessions which we have already made and which we might make in the near future, these are accompanied with reciprocal concessions from the US side.
Sure. So let me actually ask, Mr. Vadhavan, exactly that. So the common sense logic that one is hearing all around is that, let's say, pharma. And pharma imports into the US are really important for the US as well. I mean, getting drugs at reasonable pricing. So maybe that could be one bargaining chip, that they don't hike tariffs, import tariffs on incoming pharma products too much. And similarly, the same question I asked Mr. Das, where could India cut a little bit to appease the US, maybe to an extent, without hurting our own trade interests?
As Dr. Das said, America is not a major manufacturing nation, so industrial goods are not a major aspect of their exports, because they have interests in motorcycles, two-wheelers, four-wheelers. We'll have some limited interests. So we could possibly accommodate some of those interests with various safeguards. Typically in trade negotiations, you have various measures like staging of duties. The duties don't kick in immediately. You can have a tariff rate quota where the concessional tariff is on some limited quantities so that your domestic industry does not get, hurt. Similarly, the other area is agriculture. So it's not a question of what we are willing to give. That what we are willing to give has to match with what they want. So we have to consider what they want, and typically they will want concessions on, two-wheelers, four-wheelers, agri products, dairy products. So we have to then see which are the things we can do comfortably, which are the things we can do with some sort of, safeguard measures, maybe a tariff quota where there's a limit on the quantities that come in. So it's very technical, and we've done it before. We've done, trade agreements with more, significant industrial nations than the US, say Japan, Korea, ASEAN. So there is a method in this, and I'm sure we can, accommodate American requests while protecting our sensitivities and adopting various measures that can, prevent our industry from being hurt beyond an acceptable degree, let me say.
Let's see, gentlemen, very, very interesting times, whether our negotiators, and more power to all of them, people within the Commerce Ministry, whether they can walk this fine line between giving America a bit of what it wants while protecting, of course, our own Indian industrial interests as well, industrial as well as agricultural interests, of course. Thank you very much for joining in. Of course, this is an ongoing story, and live coverage will be starting a little past midnight tonight, and we will continue it well into the morning tomorrow. So, long hours coming up. But for the time being, let's shift our eye back to the market and corporate conversations. Market's holding quite steady, 60 points higher on the Nifty. Not too much of a problem there. Mid-cap is flashing a little bit of red for the time being. So with that, let's quickly get into our final corporate conversation on Bazaar for this morning. V-Mart Retail, like we've been telling you, the stock has been holding up. Last I checked, it was still up about 3%. Let's pull up the stock price on the screen. Can we do that? Yeah, there we go. Okay. It's cooled off a little bit from the opening highs. But the fourth quarter business update has been looking very good. 17% revenue growth, same-store sales growth at 8%, which is even better than what they did in the third quarter. Mr. Lalit Agrawal, founder and managing director of V-Mart Retail, is with us. Mr. Agrawal, thanks for joining in. It's good to hear, good to see, good to note, and you've been managing those growth numbers despite this ongoing, slowdown that is being spoken of. Tell us, what's driving it? Is Tier 2 demand still strong? And is it all volume, or is there any elbow room to look at pricing growth as well?
Hi, good morning, Survi. No, definitely there's a lot of work which has gone behind this, and we have been struggling for the last 3 years, but yes, this year finally has been a good year where we could achieve our growth back to what we wanted. So there's a lot of changes that we have done in the organization, but yes, definitely we are also seeing the mass consumption and the rural consumption inching up a little more, becoming a little better than the last year. And that also has driven some kind of consumption, especially in markets of Uttar Pradesh, Bihar, where we were struggling fundamentally. But I think, yes, volume growth is something which is very, enlightenment. We're really getting good news about that volume growth. And this is also being led by fashion, because there's a lot of fashion change which is coming to the market. And that is also something which is driving a little more consumption, because consumer now need a little different wardrobe in their house. These are largely also led by Gen Z and that particular population, that age group. That is something also that we are trying to drive.
No, absolutely. And full marks to you and your team, because this fast fashion category is also fast moving, right? Fast moving fashion. And it's fairly competitive as well. Lots of players in this space. So just tell us, given the strength that you've seen in the fourth quarter, and I think you'll be ending FY25 exceeding your guidance of 15% top line growth. Now, FY26, what is the kind of growth aspiration that you'd like to put in place? Volume growth, or rather, let's say top line growth, and same store sales growth that you would like your teams to deliver in FY26?
I think we definitely want to replicate this result that we have done in the last year, and we will want to have better outcome, because we are getting the grip over the business. We are getting the grip back on the fashion. There are a lot of competition which had walked into our space for the last 2-3 years. So now most of their effects have got neutralized. We are seeing them deperforming now. So I think we are gaining back some consumer. More consumers are walking into organized retail, which is a good news. And then consumers are also shifting bases from ineffective or improper retailer to a proper retailer, because we are trying to focus more on quality. We are actually trying to focus more on our repeat customers and our repeat customer sales to drive up to 75%, which is right now hovering around 70%.
Okay, all right. Hi, Mr. Agarwal. Good to see you on the show. The total store count, I think the net addition last year was close to around 50 stores?
Yeah.
53, yeah. I think so. So what
this
kind
year,
of a... Yeah.
This last year, we have added 62 stores.
62
at a
stores.
gross number. But we also closed down 8 stores. We also closed down 8 non-performing.
Yeah, that's how I come to the net addition of around 53 stores for the year, roughly. For this year, what kind of store addition are we likely to see? Point number one. And SSG, what should the growth number look like for this year? Last year, I think it was around 11%, which was relatively higher in comparison to what you were guiding of high single digit. No. All right, I think we've got you on a bit of a scratchy line, Mr. Agarwal. We'll try to get you back. Last year they added a net amount of stores of around 53 stores. That's including the additions and deducting a couple of stores that they are shut. I think we have Mr. Agarwal back with us. Mr. Agarwal, you're making that point. Please go ahead. Number of stores you're looking to add and SSG growth for the year.
Yeah. Of our square feet addition every year. We have been consistent for a decade, and then that is what we would want to again add. So maybe adding around 62 stores or 65 stores on a net number. That is what we would target even the coming year. And then definitely numbers will definitely come back. And there's a lot of hue and cry going around consumption in rural, consumption in urban. FMCG companies have not been reporting too much. But yes, there is a lot of fight going on. The middle class and lower middle class consumers still don't have too much of money to spend on these areas. They are definitely gaining back. There is a lot of tax rebates that government has given. That is also helping the consumption. And we expect some more consumption coming in especially from the tier 3 and the rural areas. That is where we believe if those consumptions are back and monsoon remains good this year as well, we would definitely clock once again almost a double-digit growth. That is what we should expect from our team, and that is what we are all getting prepared for on the like-for-like.
Okay, all right. Thanks for joining, Mr. Agarwal. You've revamped your business, as you're saying. You've put in a big effort to deliver these numbers, and we look forward to chatting up with you at the end of Q4 numbers and then lay out the path for FY26. For the time being, we slip into a short break. On the other side, Manish Gupta is waiting for us to give us an update on the commodity space.
Okay, welcome back. Well, let's shift focus to what's happening in commodities. Manisha is here with what's going to be top of mind as we head into the tariffs day. Manisha, morning.
Well, that's exactly on top of the mind, the tariffs that is, and various asset classes clearly reacting to that. If you look at the Asian markets today, Prashant, we haven't seen much of volumes come in. The total focus clearly is on what kind of announcements we would be seeing. And in turn of that, we also are looking at weaker US data that has been coming in for the last 4 or 5 sessions, starting with weak US consumer survey data. The manufacturing numbers were on the weaker side. And then it also has been about the weakness in the jobs data that the markets are reacting to at this point in time. If you look at the Citi report, it says on US tariffs, that is, that the world, as we are going into that event right now, the best case scenario would be if we look at US tariffs between the tune of 5 to 10%, that is something that the markets or the world can live with. But the worst case scenario in their sense would be if the tariffs come in between 15 to 30%. That is when you will see that big knee-jerk reaction come into the markets as the US would be on there. There also is a report from Goldman Sachs saying that depending on what kind of tariffs we do see today, there is already a 35% of a probability building up of a recession in the US market. So that clearly is the narrative that we are going into the event with. In the meanwhile, when you look at the gold prices, well, we have seen record highs into this one, 10% of gains in the previous month and 19% of gains already in this year until now. It has been a string of all-time highs coming in for gold in sense of safe haven buying from tariffs, from geopolitical tensions, because the US dollar also has declined, and political unrest. All of that money seems to be coming in sense of gold. And most importantly, this is the reason that you have seen gold prices go up quite strongly in the previous week, is that the China gold ETF has added 233,000 ounces in the previous week itself. And China perhaps would be accumulating more going forward by their insurance firms. Supportive clearly. Take a look at the crude oil prices then, and we were trading at a 5-week highs yesterday, almost nudging that $75 a barrel mark. Now, markets are watching out for reciprocal tariffs. But in the meanwhile, it also is about the OPEC and allies meeting. That happens on 3rd of April, and an expectation that they could approve an output hike of 135,000 barrels per day from the month of May there. The US crude inventories also have surged slightly, and that also seems to be weighing onto the markets right now. But as I said, all of the data that has come in from US has been on the weaker side, from consumer survey to jobs data and to the manufacturing numbers. All of that has come in on weak. What the street will also want to watch out from here on is, one, of course, the tariff announcement. Then you have the OPEC and allies meeting. And then you have the US non-farm payroll data. Well, that comes in on Friday. So it promises to be a very, very eventful rest of this week.
All right. Thanks very much, Manisha, for that. It's absolutely eventful next 2 days, Thursday and Friday, after what we will hear later tonight. Well, it's our special segment, Indianomics. My colleague Lata will be in conversation with a host of guests to discuss if the Indian banking system is going through a structural shift that could keep margins and loan growth much lower than in the past. It's a very interesting chat. We'll have Dinesh Khara, S.S. Mundra and Srinivasan Varadarajan help us sort of understand this issue in greater detail. Stay tuned.
Welcome to Indianomics. This is a banking special. Banks have been facing pressure on their margins because their lending rates have fallen because of the repo rate cut. You know, their lending rate is linked to repo rate. But the cost of their deposits has remained high. Bankers and Reserve Bank are hoping that as the Reserve Bank floods the market with liquidity, deposit rates will fall. But that hasn't happened so far. It's 2 months since the repo rate was cut. 7 trillion rupees have been infused, but deposit rates haven't fallen. Now, the other reason why deposits are staying high is Indians are saving less and less via bank FDs. Instead, they are preferring mutual funds. The mutual funds also keep their money in banks, but in the current account, from which they are frequently withdrawing for transactions. Such current accounts are unstable. So for longer term loans, banks are forced to raise 1-year money at 8% through certificates of deposit, CDs or bulk deposits. The question we are asking today, therefore, is, given the new savings pattern of Indians, is it likely that bank margins will continue to remain under pressure and never return to the pre-2022-23 levels? Will loan growth also be under pressure for want of stable deposits? In short, is the best of margins and loan growth behind us? For all these questions, I'm joined by 3 veterans: Dinesh Kara, former chairman, State Bank of India; S.S. Mundra, former deputy governor and a former chairman of BOB, Deputy Governor of the Reserve Bank; Srinivasan Varadarajan, Chairman of Union Bank and a veteran banker at Axis in his previous avatar. Gentlemen, thank you very much indeed for sparing time for me. I'm deeply grateful. Let me start with someone whom I can call a practicing banker, Srini Varadarajan, who is still the Chairman of Union Bank. Srini, what is your sense? Is this shift in savings behavior going to permanently impact banking as a business? As Uday Kotak puts it, that there is a challenge to the business model.
I think you've got to look at it from multiple perspectives. You're looking at the last couple of months, which has been, which everyone knows is the busy season as far as the banking system is concerned. And the maximum growth happens in that quarter. I think looking at it as a signal for what is deposit rates, it's not necessarily the right indicator. We will see some of the deposit rates coming down this quarter, which is typically sort of a lean season. So that is one aspect. The other aspect which you touched upon is that whether the peak of bank margins in terms of NIMs is behind us, and is that something which we need to factor in going forward? I would think the market to a large extent is reflecting that, even though every analyst on the street is to some extent overweight banks or recommending banks. I think the banks are struggling to perform over the last couple of years. That, to a large extent, is due because of consolidation of market share amongst few banks. If you look at the last couple of years, incremental market share of 3-4 banks is above 50%. And therefore, every other bank is forced to fight for the remaining piece of the pie. And that, which means that when you're looking at bulk deposits or CD rates, when rates are set at a high level, others typically become price takers. And therefore, costs are not coming down on the deposit side. As you said, CASA and retail term deposits are growing at a steady pace, but nowhere to the pace which credit growth is happening. And therefore, NIMs continue to be under pressure and will continue to be under pressure.
Okay. Well, let me get Mr. Khara in on this. Clearly, he is a price setter. I mean, State Bank is one of the guys who's doing the consolidation. Mr. Khara, we don't see rate cuts even from State Bank. And liquidity aplenty has been given. A CRR cut in December, almost 7 trillion rupees by way of OMOs, swaps, you name it. And now we have ended the quarter with a little bit of a surplus, actually, in the interbank system. What is your sense? Is there a permanent problem? In spite of liquidity, will this deposit cut not be commensurate with the lending rate cut?
Well, I think I tend to agree with what Mr. Srinivasan has just mentioned. There are different segments of the economy, and when it comes to the seasonality of the deposit and the credit of the economy, there are various dimensions. And when we look at that, from that point of view, what you mentioned in terms of repo rate cut, whether repo rate cut will get reflected into the reduction in the loan rates. Well, when it comes to external benchmark, when it comes to public sector banks versus private sector banks, private sector banks have got a very significant portion of their assets which are on the external benchmark, which is essentially linked to the market rates, which would be repo rate, which would be external benchmark, could be the repo rate, or it could be call money rate, or MIBOR, etc., etc. So those are the rates which have got undergone a change immediately. So that particular segment has witnessed the reduction in interest rate. But when it comes to repo and also the MCLR, majority of the public sector banks have got MCLR as the rate, as a benchmark rate. That's one of the reasons why probably we don't get to see the reduction in interest rates as far as the public sector banks are concerned. But there also I would like to mention that I've seen ever since the repo rate cut has happened, many of the banks have reduced their home loan rates. And that is something which is very clearly a reflection that, when the asset book of a particular segment is performing very well, so naturally the credit cost is much lower. And that is where the banks are in a position to pass on the reduction in the repo rate also. It's more indicative also. But nevertheless, when it comes to MCLR competition, there are multiple factors which are at play. And one of the very important factors in MCLR happens to be the deposit rate. So when it comes to deposit, particularly, when we look at the credit deposit ratio for the system as a whole, which is around 80%. So naturally, when the credit deposit is at 80%, so there are many banks which are clamoring for the deposit. And similarly, when it comes to the price setters also, what you mentioned in terms of, banks like State Bank of India, who are witnessing about 12% plus growth in terms of the loan book. And also when it comes to deposit, they have to maintain the pace of the deposit growth. So they cannot be out of the market. And that is the reason why perhaps they have not seen the reduction of interest rate in the deposits.
Okay.
There are, we look at it from the point of view of the structural changes, a couple of structural changes which have happened. We have seen that, for last 10, 12 years, there is significant growth in the mutual fund AUM.
Yes.
It used to be about 12 trillion. Today it stands at about almost about 67 trillion. So that very clearly means that it's one segment of the society who have become saver in this particular situation. They have only seen the upside of the mutual fund. Only for last about 2 months' time, they have started witnessing the reversion to mean.
Yes.
And that is one of the reasons why probably you would have seen that, when it comes to SIP, whether those SIPs have been paused or there have been stoppage of SIPs. So I think this is one phenomenon, what you mentioned, whether deposit will go away and people will go only for the mutual fund. Perhaps this is one area where now the behavior will undergo a change.
Yes.
This generation of the savers will probably have much more matured outlook. There will be allocation principle which they will be applying. They will be going deposit and as well as for the market instrument, depending upon the risk appetite.
No, that's the point, sir. My father saved only on FDs. Whereas I would assume that, and I am on the threshold of retirement in a few years, I would perhaps be more, different in my asset allocation. So, Mr. Mundra, my more elementary point, I take what Srini and Mr. Khara are saying, seasonal, slack season, busy season, all that is taken. But isn't there a permanent issue that lazy deposits era is over? And therefore, bank margins won't be what they were. Banking business won't be as easy as it was.
Okay. Interesting point, Lata, and both Srini and Mr. Khara has made very relevant point. But let me start with, there had been certain narration, and you have also mentioned recently. Number one is about, looking at that you raise deposit 8%, where the cost ultimately comes near to 9%, and you land at 8.5%.
Yeah.
Similarly, there had been narration that CD ratio is running at 80%. Now, what I would like to argue that these are a very valid point, and they indicate to a long-term trend, but they are not as binary as we can very simplistically look at them.
You're referring to the, I think we should run the Uday Kotak tweet. I think you're referring to that. That 8% cost and 9.5%, 8.5% home loan.
Yes, I am referring to that. The fact remains that while you are raising deposit at 8%, you are also having the CASA, which is maybe 3 to 5 or 7% in saving rate and zero cost at current account. So ultimately, you look at blended cost. Why I'm telling it is not as binary. Similarly, you are talking about that a home loan is given at 8.5%, but at the same time, there are loans which are also earning 11, 12%. So again, you have to talk about the blended yield. The point I am trying to make, Lata, that with all this, even with the trend which is little declining, but if you look at the NIM of Indian banks, they are still very high if you look at globally. So there is a room, and there is a atmosphere is building up where I agree these NIMs have to come down to a level which is more matching with that. But the basic point is, to my mind, yes, there may be seasonal factors. It's quite possible that banks are also building up the war chest. So I agree with Srini that couple of months or 3 months did not to be taken as a permanently lasting trend. But my opinion, fact remains, this is a high time for Indian banks that they will have to look at the credit side and move away from this model of, getting into wedlock with an asset. Means you underwrite an asset and then till maturity it remains. It has to be originate and distribute model. And for originate and distribute model, you have to have an efficient market. It was not there at all few years back. Today there are avenues are available. But fact remains that lot more is to be done, and banks have to be prepared for this change where the NIM would be under pressure, NIM would be declining, and they would have to learn to recycle their assets and do the new underwriting. As well as one last thing. One cannot
can I come to you? Can I come to you in a minute? I'll come to you in a minute. I take your point entirely that one point you make, yes, the era of lazy deposits and therefore high NIMs is under challenge. And secondly, that now banks have to circulate their assets, buy and sell their assets a little more. I'll come to that in a minute, but I wanted to ask Srini another thing. The constant criticism, I get even trolled for that ultimately money remains in the banks. And therefore, why are you all cribbing? I got trolled terribly on X for this. You tell me why it is not different. That money coming as FDs and money staying in the current account of a mutual fund, why are they fundamentally different?
Clearly, as you initially said, the behavioral analysis indicates that, the current account deposits are volatile and you cannot rely on them for long-term lending. So the point one needs to understand, and one possibly the market or the regulator needs to sort of mandate, is that banks need to disclose quarterly average balances of all these deposits, whether it's current accounts, savings accounts, retail term deposits, and bulk and CDs. Because the composition of this is changing. The liability composition is changing. Even though a year-end number looks like X, actually the average balances are not that. And the composition of current and savings accounts in the overall liability profile is coming down. The system is growing credit at a faster pace than the average balances of CASA are growing in the system. Therefore, even though these are low-cost deposits, their share in the overall liability profile is coming down. Therefore, the cost is getting pulled up. So structurally, the NIMs are actually declining, and that is the truth, and that is going to continue. And I agree with Mr. Mundra that, banks have to be prepared for lower NIMs. I think whether you call it lazy banking, whatever we call it, I think the CASA profile of banks and as a percentage of the overall liability is coming down on an average basis. That has implications for cost of funds, and that has implications for NIMs, and that is not going away.
Okay, I was going to put that last line to vote. Are NIMs structurally headed lower? Srini and Mundra have already said yes. Mr. Khara, where do you stand? Just yes or no. Are NIMs structurally lower?
I would say that if at all you're looking at NIM of 4, then perhaps yes. If at all you're looking at NIM of 3, then perhaps no.
Okay, well, I will take it as 2.5 votes out of 3 that NIMs are headed structurally lower. I have to take a break. I'm going to come back with what regulators can do or maybe need to do. After a break, for Bazaar viewers, that part will be available after market hours, Chartbusters time for you.